Our next guest says that gold prices will climb above $1,200 by the end of the year. He's looking for an acceleration in price to the upside. Ralph Preston is a market analyst at Heritage West Financial. He follows the gold market closely and joins us now from San Diego. Ralph, welcome to Bloomberg News.
Hi, Mark.
You're expecting over $1,200. Tell us why.
Well, I believe the stage is set after Friday's unemployment report confirmed that the jobless rate here in the country is still at a 26-year high. Once again, this puts the Fed in between a rock and a hard place when it comes to raising rates. That is the overall economic backdrop to which the price of gold is beginning to hold above the $1,000 level now. Not only, Mark, on a daily basis, but during the month of September, we saw the price of gold close above $1,000 on a daily, a weekly, and also a monthly basis, Mark. This is telling us from a technical point of view that the stars are aligned for a move to the upside, as we're getting all major time frames, daily, weekly, and monthly, all pointing to the upside right now.
How do you think the market would react, the gold market that is, if there was a sharp pullback in, say, the equities? A lot of times we've been noticing the correlation between gold as more and more of a risk asset, and it's been moving more in conjunction with the equities instead of inversely to it.
Yes, that dynamic, Michael, seems to be clearly in place, and until that dynamic is broken, I'm actually going to anticipate that correlation to continue to play itself out. However, I don't know what it's going to take to break that correlation. I don't think it's out of the question that we might slip back and test Friday's low of 984, but overall, today's close above 1015 sets the market up for a challenge of 1025, and then from there, if we can get a close above 1025, I'm going to look to challenge that contract high in December at 1,060 for a contract high.
Ralph, to pick up here on what Michael was just talking about in terms of the equity correlation, we've talked to several people today, Nouriel Rubini among them, who have said, you know what, equities are in a risky period right now and we could see a pullback. Why isn't that going to mean the same thing for gold then, if we have seen that correlation recently?
We've seen the correlation recently. It is not confirmed that it is still in play, nor has it been broken as of yet. So it's going to test that correlation. We're going to have to see gold either take a big upward move or a downward move, and see if equities move in relation to as we've been expecting. However, I do suspect that as we enter into the third quarter, that correlation will begin to break down.
But Ralph, is $1,000 too high for gold in your opinion?
The market clearly is telling us that at the moment, no, it's not. It appears that we're in a new paradigm, a new trading paradigm, being in the first decade of the 21st century. The price of gold has risen steadily for the past 9 years, and I think that the price of gold is a reflection of the changing geopolitical world order during the past 9 years. So we're definitely in a new economic era now in 2009.
Ralph, what do you think would happen if there was some sort of regulatory movement? We've seen a lot of investment flow into gold and gold ETFs. Let's just say the CFTC decided to do something to limit and possibly get rid of the swap loophole and limit the effect that some of these, retail investors and other commodity index funds are having in gold. What kind of effect do you think that would have on the gold prices?
I could see a short-term knee-jerk reaction to the downside. However, I don't see regulation actually squashing gold and keeping it under $1,000 an ounce. Now that we are sitting firmly atop of the previous all-time high at $850, I think we're here to stay.
Ralph, I also want to talk about gold in relation to some of the other precious metals. Silver and platinum, notably, on a percentage basis, have done much better than gold thus far this year. But you expect, obviously, with gold going higher, you expect that to reverse a little bit. Do you see silver and platinum falling back and gold then doing better? Talk to us a little bit about the relationship.
What it is with that, Julie, is I don't see an other market, metals market right now, that clearly defines a bullish setup, a chart pattern. I don't see a bullish chart pattern right now in the silver market, the palladium market, or palladium. For that matter, copper as well. I think those metals that I just mentioned to you, they've outperformed gold on a percentage basis, primarily being that they were reflective of the economic recovery that the economy experienced during the first half of 2009. I believe that's why the industrial metals outperform the price of gold. Moving forward, however, as far in terms of a chart-based pattern, on a weekly basis, I'm monitoring a head and shoulders reversing pattern in the gold market, and that the price of gold is able to close and hold above resistance at $1,000 an ounce is
so
breaking
Ralph,
the neckline.
Is it all technical here? I mean, let's say in India gold demand just doesn't show up. We've heard just how the poor monsoon is really affecting agriculture incomes, and that's where 70% of the physical demand for jewelry comes in. Let's say, I mean, if it's not technical and there's no physical demand, isn't this market susceptible to a sharp pullback?
Well, I think that's a good question as well. However, I believe that the overall economic environment, as I started off discussing how we're sitting at a 26-year high right now, really has just put the Fed in between a rock and a hard place. Not only that, but we're also sitting at, in my mind's eye, what appears to be the last moments of a 6-year drama that's been unfolding between Iran and the West.
Right.
And I think gold is also telling us that as well, that we're seeing safe haven and firming on that level. I think that what could be the...
Ralph, I'm so sorry. We're running up against a break. We're going to have to leave it there, but we'll have you back. Ralph Preston of Heritage West Financial.